What if the biggest AI investing opportunity of the next decade isn't the company building the most popular chatbot? What if the real winners are the companies almost nobody is talking about? The companies providing the chips, the electricity, the cooling, the networks, the cybersecurity, and the software that makes the entire AI revolution possible. Because here's the uncomfortable truth. Most investors are looking at AI from the front. They're watching the flashy products, the viral announcements, the newest models, the companies making the biggest promises. But behind every AI breakthrough, there is an enormous machine of infrastructure making it possible. And that machine is growing. So here's the question that could completely change how you look at AI investing. What happens when the first wave of AI is already crowded, but the second wave is just beginning? Because if you spend the next 5 years chasing yesterday's AI winners, you may completely miss where the next wave of money is actually going. And by the end of this video, you'll understand the entire AI investment cycle. Why volatility may actually be your greatest advantage. Why sitting in cash can quietly destroy your purchasing power, and which parts of the AI infrastructure could become the real winners of the next wave. Because the biggest opportunity may not be where the crowd is looking, and that is exactly where this gets interesting. Let's start with a painful truth about investing. The stock market has historically delivered strong long-term returns. But despite that, a huge number of individual investors still lose money. Why? Because the problem usually isn't the market. The problem is investor behavior. People buy when everything feels safe. Then they sell when everything feels terrifying. They chase stocks after huge rallies, then panic when those same stocks fall. In other words, they do the exact opposite of what long-term wealth creation requires. Imagine two investors. Investor A sees the market fall 30%. They panic. They sell everything. They promise themselves they'll buy back in when things feel safer. But the market starts recovering. Then it goes higher and higher. Eventually, investor A waits until the headlines become positive again, and that is when they finally buy back in, usually at much higher prices. Investor B does something very different. They understand that volatility is not a bug in the market. It is part of the system. Markets rise, markets fall. Businesses go through cycles. Technology changes. Fear comes and goes. But quality companies can continue growing through all of it. And over long periods of time, the investor who stays focused often beats the investor who constantly tries to predict the next headline. That is the first principle. You do not build generational wealth by predicting every short-term move. You build it by owning quality businesses and giving them enough time to grow. Now here is where many investors make another mistake. They look at the market and say, everything is expensive. I'll just wait for the crash. Sounds smart, right? But there is a hidden problem. Waiting is not free. Because while your money sits in cash, inflation continues working against you. The number in your bank account may look the same, but what that money can actually buy may slowly decline. And this is why long-term investors need to think in terms of purchasing power. You are not simply trying to grow the number in your account. You are trying to grow what that money can actually buy in the future. Meanwhile, the stock market can experience wars, pandemics, recessions, political crises, interest rate shocks, and countless scary headlines. And yet, over long periods of time, the market has continued to reward ownership of productive businesses. This does not mean stocks go up every year. They don't. There will be crashes. There will be painful corrections. There will be moments when the market feels completely broken. But the biggest mistake is assuming that a temporary decline automatically means the long-term story is over. Because historically, The market does not move in a straight line. It moves upward through cycles. Rally, correction, fear, recovery, another rally. And the people who constantly wait for the perfect moment often miss the most important part. The market's best days frequently happen close to its worst days. That makes timing extremely difficult. So the real question is not, can I predict the next crash? The better question is, what businesses would I still want to own 5 or 10 years from now? That question changes everything. Now let's talk about the biggest investment transformation happening right now: artificial intelligence. But here is the twist. Most people are looking at AI in the wrong way. They are focusing on the visible products, the chatbots, the applications, the newest model, the company with the most impressive demonstration. But technological revolutions usually create wealth in a different way. Think about the gold rush. The people who made the most reliable money were not necessarily the people who found gold. Many of them sold the tools, the equipment, the transportation, the infrastructure, the things every gold miner needed. And the same principle could apply to artificial intelligence. Because the more powerful AI becomes, the more infrastructure it needs. More computing power, more data centers, more electricity, more cooling, more networking, more storage, more cybersecurity, more software. And this creates a very important investment idea. As AI becomes cheaper and more widely available, demand for AI may actually increase. And as demand increases, the infrastructure supporting AI may become even more valuable. This is why the second wave of AI could look very different from the first. The first wave was dominated by the obvious winners: the chips, the hardware, the companies building the computing power needed to train and run AI systems. But the next wave could be about everything built around that hardware, the systems that connect it, power it, cool it, secure it, and help businesses actually use it. That is where the opportunity becomes much broader. So what are the major layers investors should be watching? The first is compute and semiconductors. Artificial intelligence cannot function without massive amounts of computing power. And this is where companies like Nvidia have built an enormous position. The advantage is not just the hardware, it is also the ecosystem surrounding that hardware. Software, tools, developer support, compatibility, and the enormous switching costs created when companies build their entire AI infrastructure around a specific platform. That creates something extremely valuable in business: a competitive moat. The second layer is semiconductor manufacturing equipment. Because even the companies designing the most advanced chips still need the machinery required to manufacture them. And this is where companies like ASML become incredibly important. The key insight is simple. You can invest in the companies making the chips, or you can look at the companies supplying the machines that make the chips. Sometimes, the infrastructure provider can benefit from the growth of the entire industry, not just one individual product. The third layer is networking. Think of AI data centers like enormous cities. The computing systems are the buildings, but the networking infrastructure is the road system connecting everything together. As AI workloads become larger and more complex, the amount of data moving between systems increases dramatically. That means high-speed networking becomes critical. Companies like Arista Networks are positioned in this part of the infrastructure. And this is exactly why investors should look beyond the most famous AI names. Because sometimes the quiet company supplying a critical part of the system can become just as important as the company receiving all the headlines. If you're finding this breakdown useful, take a second to hit the like button and subscribe to the channel. Because on this channel, we break down the biggest trends in markets, technology, and investing in simple, practical language. And if you want to understand where the next major investment opportunities could be hiding, you definitely want to stay with us. Then, there is a problem most people rarely think about. Heat. AI systems consume enormous amounts of power. And enormous amounts of power create enormous amounts of heat. That heat has to go somewhere. Which means cooling technology becomes increasingly important. This is where companies like Vertiv enter the picture. Data centers cannot simply keep adding more powerful AI systems without solving the energy and cooling problem. So as AI expands, the demand for cooling infrastructure can expand with it. This is the pattern investors need to understand. A new technology creates a new problem. That problem creates a new industry, and sometimes the company solving the problem becomes one of the biggest winners. But the most interesting layer may be software. Because hardware creates the physical foundation of AI, software helps businesses actually use it. And this is where companies like Palantir have attracted so much attention. The investment thesis is not simply about artificial intelligence being popular. It is about businesses needing systems that can turn enormous amounts of data into real-world decisions. Defense, manufacturing, logistics, healthcare, energy, government, large organizations do not just need a chatbot. They need systems that connect data to operations. They need software that can help them understand what is happening, what is about to happen, and what action they should take next. That is a much deeper opportunity than simply creating another AI assistant. And this brings us to one of the biggest investment lessons of the entire AI revolution. The best companies may not always be the most exciting companies. They may be the companies quietly becoming essential. Now, the AI infrastructure story does not stop with chips and software. There are several other areas investors need to watch. Energy is one of them. AI data centers consume massive amounts of electricity. And as computing demand increases, the energy requirements increase with it. That makes power generation and energy infrastructure increasingly important. Nuclear energy is one area receiving growing attention because of its ability to provide large amounts of consistent power. Companies connected to energy production could potentially benefit from the enormous electricity demand created by AI. Then, there is cybersecurity. The more valuable AI systems become, the more attractive they become to attackers. Companies are going to need stronger protection for data, networks, and AI systems. So cybersecurity could become one of the most important parts of the entire ecosystem. And then there is robotics. This may be one of the longer-term opportunities. Physical AI. Machines that can see, learn, move, and interact with the real world. This is not going to transform every industry overnight. That is the important part. Some of the biggest technological changes take years to develop. Investors who expect every opportunity to become profitable immediately often lose patience too quickly. But the people who understand the long-term direction and patiently identify the companies building the infrastructure may have a completely different experience. So what is the biggest mistake investors could make right now? Chasing the story that has already become popular, instead of asking what comes next. The first wave of AI created obvious winners. The second wave may create a much larger ecosystem of companies. The winners may include semiconductor companies, chip equipment manufacturers, networking providers, cooling infrastructure, cloud platforms, energy producers, cybersecurity companies, enterprise software, and eventually physical AI and robotics. The key is not to blindly buy every company connected to AI. That would be a mistake. A company can be part of a great industry and still be a terrible investment if the price is too high. That is why the foundation matters. You need to understand the business, the competitive advantage, the growth, the balance sheet, the valuation, and the long-term opportunity. Because the goal is not to find the most exciting stock on the internet. The goal is to find businesses that could still be important years from now. And here is the final lesson. You do not need to predict every market crash. You do not need to know exactly what the Federal Reserve will say next month. You do not need to react to every headline about politics, wars, inflation, or interest rates. Those things can matter in the short term. But over 5 or 10 years, the biggest question is often much simpler. Are the businesses you own becoming more valuable? Are they growing? Are they building something difficult to replace? Are they positioned inside a trend that could expand for years? If the answer is yes, short-term volatility may become an opportunity instead of a reason to panic. Because the future of AI is not just about the next chatbot. It is about the enormous infrastructure required to make AI possible. And while millions of investors are chasing the shiny new technology, the biggest long-term winners may be the companies quietly selling the tools, systems, power, networks, software, and security that the entire revolution depends on. The crowd usually focuses on what is visible. Smart investors start looking at what is necessary. And in the AI revolution, the most valuable question may not be, which company has the most exciting AI? It may be, what does every AI company need? Because once you find the answer, you may start seeing the entire investment landscape differently. So if this video helped you see the AI investment landscape from a different angle, make sure you hit the like button and subscribe to the channel. Because the next major investment opportunity may not come from the company everyone is talking about today. It may come from the company quietly building what everyone will need tomorrow. And if you want more clear, practical breakdowns of AI, markets, technology, and long-term investing, you'll want to be here for what comes next.